Hello, I'm Peter Towers, Managing Director of ESS BizTools and ESS Small Business. Welcome to Empowering SMEs. Budgets and cash flow forecasts help. They help companies, they help all sorts of organisations. Therefore, company directors and committee members of not-for-profits, charities, sporting and social organisations need to have a clear understanding of how the budgets and cash flow forecasts for your company or organisation are prepared. Directors and committee members should understand what the process has been, what the involvement has been out of the team within a particular business unit in the preparation of a budget. Because a budget is just not last year's figures plus a percentage figure. As a director or a committee member, you would expect your team and management to have delved far further into the background, what's happening in the business, what's happening with in the market, what are competitors doing, what are the price pressures, what do customers want, and what are customers prepared to pay for. And all this should be taken into account in the formulation of the budgets. Budgeting is forecasting the future. And what it does, it gives the opportunity, first of all, for the team and then management to rethink what a strategy is, because they've seen what on paper it is going to look like. And then the board of directors should not just be a rubber stamp, but should inquire as to how the budgets have been prepared and make suggestions on changes if that's required. The budgeting process starts therefore with the team collaborating on the project, making their input as to what they think is going to happen in the business, and then it can be reviewed by senior management, and ultimately it is submitted to the board and or committee for approval and sign off by the board and the management committee. So let's look at the budgeting process for a trade business organisation. Firstly, the team needs to be in general consensus of the type of work that the business is going to try to secure in the next 12 months. And what will be the team that's going to be required to deliver on that work? Are extra tradesmen needed? Is there some extra skills needed in other areas like computer software? The next calculation is what's the labour on costs going to relate to during the year? What's it going to cost? This covers things like holiday pay, statutory holidays, superannuation, payroll tax if it's applicable for the company or organisation, etc. The labour budget can then be prepared, and this requires a detailed schedule to be prepared for each team member, showing their projected work hours, what the expected productivity percentage for those individual team members is going to be, and therefore what should be the saleable hours that the business will have available. There needs to then to be a determination on the required return on investment. The board of directors may have established this and said, we require a 20% return on the assets that are being utilised within a particular business unit. Whatever the methodology, a profit needs to be determined. This is what we are targeting to make in the next 12 months. Overhead expenses are the next very important item to consider, and these should be prepared accurately. Obviously, what's happened in the past should be taken into account, but realistic estimates should be included for things like social media, marketing, advertising, and all of the other costs that relate to the overhead expenses of a particular business. The amount of materials that it's estimated that the business is going to have to acquire during the year for installation onto clients' projects then needs to be determined. This can be quite a sizable figure for some trades businesses, and it needs to be factored into the cash flow forecasts that will be prepared once the budget has been finished. The next stage is to determine what the materials markup percentage is going to be. This is a recompense to the trades business for having gone to the trouble of identifying where various products can be obtained from and then purchasing those products, getting them ready for installation onto the client's project. Now the markup might be 5%, 10%, 15%, but it can end up being a considerable amount of money over a 12-month period. What the decision needs to be made then is, will this be a separate profit item within the business, or will it be utilised to offset what would have been the charge out rates for employees' time? In other words, is it taken into account as a credit item in the determination of the individual employee charge out rates? And that's up for each company and organisation to determine. Many organisations factor in standardised write up or write down rates when charge out rates have been determined. I don't particularly like it, but it's the reality of what happens in the world. So if you're going to do that, that needs to be brought to account. What the business is then able to do is to calculate the targeted income to be generated from a charge out of team members' times. And it's calculated because we now know what the labour cost is going to be for the 12-month period, what the labour on costs are going to be. We know what the targeted net profit is and the business's overhead costs. If you're making any adjustments for write-ons or write-offs, you'd bring that into account. And you can also decide whether you're going to bring into account, in effect, a credit for the materials markup, or leave that as a separate income item within the company or organisation's profit and loss account. You then are able to process through a computer package to determine the individual charge out rates to be charged by each team member for their time during the year. Management's role is to closely monitor all of this to make sure that on a month-by-month basis, the targeted hours are being charged, the productivity percentages are in line with the budget, and if it's found that it's not possible for certain team members to achieve the productivity percentage that's been set in the budget or the work hours, there will need to be an adjustment made as soon as possible in their charge out rates. We then move to the cash flow forecast. The cash flow forecast obviously follows the budget phase of the process, but it then brings into account debtors. What are the debtors days outstanding expected to be during the year? Creditors. What's the creditors' terms of payment that the business has to make? Are there loan repayments to be made? Is it projected that there's going to be significant capital expenditure? What's that going to be? That should be included in the cash flow forecast. And when the cash flow forecast is finalised, you will be able to compare that to the overdraft limit that your banker has granted to this company or organisation to determine whether there needs to be some urgent discussions with your banker about increasing the limit. The other documents that are prepared as part of the budgeting and cash flow forecast include a projected balance sheet so that the directors can see what the overall effect of all of this, when all of the business units are brought to account, and the cash flow forecast, what's the company's position going to look like in 12 months' time? And that's best conveyed in a projected balance sheet. And the other key document is the projected source and application of funds. Whilst the source and application of funds, I think, is a very important document to help explain what happened in the previous year's financial performance, it is just as important to explain in simpler terms what the projections are saying will happen in the next 12 months. So always ask for a projected source and application of funds to be produced. Now, we have an expert who's going to talk to you about all of these budget and cash flow matters in the Corporate Governance Network. and that is Paul Barnaby, who's a very experienced chartered accountant, but he's also the regional integration consultant for Plan Guru, a major international organisation that produces budget and cash flow forecast software. Paul will be talking in 4 of the 8 Corporate Governance Network webinar workshops that are available for any company director, officer or committee member or officer of organisations, or accountants if you also want to improve your skills and knowledge in what happens in boards of directors and management committees. If you have any question on any aspect of the Corporate Governance Network, please go to our website www.ess017.com.au and click on Corporate Governance Network. If you have questions, please send me an email, peter@ess017.com.au. Have a great day. Goodbye.